Hey, my name is Michael and I'm the content lead at Simply Wall Street. In this video, we're going to focus on the bullish and bearish cases for Visa, and we'll show you how those narratives translate into respective valuations for those opinions. More importantly, once we're done with that, we'll show you how to build your own narrative based on what you think is probable, and then how you can translate that into your own valuation. Because as you know, with Simply Wall Street, we want to help you think long-term, reach your own conclusion, and be a lifelong learner. So let's dive in. We'll start with a quick overview of the business. Visa operates the world's biggest payment network, authorizing and facilitating payments between credit and debit card issuers and a merchant's bank. If you use a Visa card to make a payment, Visa connects your bank to the merchant's bank and then processes the transaction. The merchant pays a fee that is split between its bank, your bank, Visa, and in some cases other intermediaries. Visa's global market share is around 40%, while in the US it's over 50%. Its biggest global competitor is UnionPay, while in the US and Europe its biggest competitor is MasterCard. Now let's have a look at some of the strengths and opportunities that Visa has. Visa has plenty of strengths, but we're going to focus on just 3 today. The first strength is that it's operating in a duopoly with MasterCard, and they both have incredibly strong network effects. Visa and MasterCard dominate the global credit and debit card markets. Imagine you went to a cafe with a fancy new card from a new provider. If that cafe doesn't accept that card, you're out of luck. Visa and MasterCard, with their huge global payment presence and networks, are the largest providers of digital transactions, and they've cemented their position. For a new payment provider to enter the market, they'd have a lot of catching up to do to establish the same trust, networks, and cost efficiencies that these two currently have. These networks are so embedded that they strongly incentivize users and merchants to use and accept Visa branded cards. That's because consumers need to carry cards accepted by merchants, and merchants virtually all accept Visa and MasterCard. Then from the merchant's point of view, they need to accept Visa cards because most consumers have bank cards that actually use Visa's networks. The banks that issue the cards earn between 50 and 90% of the total fee, and it uses these lucrative fees to help offer rewards to consumers. It's important to remember that Visa only facilitates the transaction, and it doesn't actually take on any credit risk because that's what the banks are doing. The second strength we'll focus on with Visa is its operating leverage, which it has achieved through its massive scale and its high operating margins. Visa earns a relatively small slice of the merchant's fee, but due to the massive volumes that are transacted on its network, these add up to considerable revenue. For example, the volume transacted on Visa's network in 2022 was $11.6 trillion, and that translated into $30 billion of revenue for the year. Visa's volume and scale translate into very wide margins, which continues to improve as the business grows. For example, you can see here that the operating margin improved from 61% in 2013 to 67% in 2022. The net income margin improved to 50% in 2022, and the free cash flow margin is also over 50% by last year. All of this is proof of just how incredibly profitable this business model is. The high free cash flow margins has allowed Visa to purchase back 20% of its shares over the last 10 years and increase its dividend every year since going public. Those share buybacks have resulted in earnings per share increasing 275% in the last 10 years, while net income has actually only grown by 200%. Lastly, the third strength we're going to focus on is the multiple industry tailwinds that are benefiting Visa's business model. Payment networks like Visa benefit from several ongoing trends. Firstly, the transition away from cash. Cash is still used for more transactions globally, however, the cashless transactions have overtaken cash in terms of its total value. I hope that makes sense. Secondly, global economic growth and commerce have consistently grown and are expected to continue growing over the long term. Specifically with exposure to both e-commerce and in-person payments, Visa is well positioned to benefit from this ongoing trend. And lastly, the increased use of credit. Recent reports have shown that global credit card payments are expected to continue growing at 7.6% per year from last year until at least 2026. As of 2022, these above trends show no sign of slowing down, so these are all tailwinds for Visa. Now, those are the 3 main strengths that Visa possesses, but there are 2 opportunities that are just worth briefly mentioning. Firstly, Visa runs numerous partner programs working with businesses in new and evolving industries, including fintech platforms, crypto projects, and content creators. These programs could help entrench itself in new areas of growth. And the second opportunity worth mentioning is that credit and debit card penetration in emerging markets is still actually quite low, while disposable incomes in these areas are increasing. This is another good growth opportunity where it is well positioned to benefit, but it's still very early days. Now, all of these strengths have not gone unnoticed by the powers that be. Visa and MasterCard's duopoly and their high margins have made them a prime target for alternative payment systems and regulators alike. So let's have a look at some of the risks facing Visa. These market regulators are often the bane of all financial services companies, and rightfully so. These regulators aim to create a market environment that is fairer for consumers, but that often comes at the company's expense. So here are some of the particular aspects of Visa's business model that we need to consider and understand in order to assess its future prospects well. Firstly, European, UK, and Australian regulators have already actually capped the fees that merchants pay to these payment networks. While these caps have not had a noticeable effect on revenue, there's always a chance that these capped fees could be lowered even further. A second probable risk to Visa is the Credit Card Competition Act of 2022. This proposal, which was drafted in the US, where Visa earns 45% of its revenue, would force issuing banks to offer a choice of two networks over which transactions on their cards can be processed. And the important point is, one of which can't be Visa or MasterCard. This move is an effort to curtail some of Visa and MasterCard's dominance in the market. This bill is controversial because it's likely to impact the rewards programs that are actually really popular with the banks and their consumers. And while it's not yet to be voted on, many expect that it will eventually be passed in some form or another. A third risk to consider for Visa right now seems to be the tough competition that's emerging within the financial services industry. Fintech platforms like PayPal or Block offering digital wallets and the open banking trend all offer consumers alternative ways to pay at the counter, which impacts Visa at its very core. For those that don't know, open banking refers to a new banking initiative that plans to deliver people with greater transparency over their own financial data. Companies in Australia are already exploring the possibility that this open approach to banking can lead to safer, cheaper, and easier ways for consumers to pay merchants directly from their bank account without the need to use the likes of Visa as a processor for the payment. Obviously, the more transactions processed by these market disruptors, the fewer transactions would be processed by Visa's network. Visa's current dominance in the market is a result of people not really needing another method, but with the landscape and transactions becoming increasingly more digital and new technologies emerging, that could certainly change. With the recent rise of cryptocurrencies and blockchain-based protocols showing people that decentralized finance is a possibility, people may begin gravitating towards other digital payments, but only if they can offer an improved utility at a lower cost. As a result, the prospect of Visa maintaining its current market shares can become less certain. It's important to realize that a key weakness for Visa is that it doesn't actually have like a product or service differentiation or even brand loyalty for that matter. Most people see no discernible difference between transactions processed by Visa or MasterCard. They simply just want the payment to work. So if one of these market disruptors cropped up offering a service that was way more valuable to the modern consumer and merchant than Visa in terms of cost, convenience, and security, then there will be little in the way of brand loyalty preventing customers from jumping ship. Now that we've covered all that, let's have a look at the current situation for Visa and what its share price implies. Visa's current share price of $220 implies earnings per share growth of around 15% per year if growth continues for a few more years before declining. That is, of course, also making assumptions about the discount rate, the years of growth, etc., which you can see you can adjust here on the left-hand side. Now let's talk about the narratives surrounding Visa. To start with, we'll cover the analysts who are bullish on Visa. The bullish analysts have earnings growth estimates of 22% per year, which is actually higher than the historical growth rates. The bullish catalysts supporting these higher growth estimates would probably assume that the trends and momentum that have driven Visa's growth over the last 10 years will remain in place. Here's a few examples of some bullish catalysts. The first catalyst for the bullish case would be based on the assumption that the transition from cash to electronic payments will continue and even accelerate in some markets. The second bullish catalyst would be if there is a recession, it will likely be relatively mild, followed by a strong recovery. Any slowdown in earnings growth for the company would be temporary and would be made up for during a recovery, as it was after 2020. The third bullish catalyst would be around regulations. Expectations here would be that any new regulations in the US are likely to be watered down to the point where they have little impact, and most of the impact will be felt actually by the issuing bank rather than Visa. Now, regulations that are introduced could also be delayed by legal challenges from the company. The fourth catalyst could be around disruption from new entrants and new technologies. The bullish point of view on this is based upon the little evidence so far that Visa's business is actually being disrupted, and if it does occur, it will likely take years to have a meaningful impact on Visa's top and bottom lines. In fact, Visa actually benefits from fintech and crypto platforms as they often use its network to process transactions on and off the platforms. The last bullish catalyst would be around Visa's ability to maintain its scale and therefore its margins and earnings per share growth. More specifically, Visa's margins will continue to gradually rise as it benefits from economies of scale. And expectations would be that if its free cash flow is continually used for share buybacks, this will enhance its earnings per share growth. Now, those are some of the bullish catalysts around Visa stock. If you agree with these narratives, you might expect earnings growth to be at the higher end of analyst forecasts. A 22% growth rate, along with a few other assumptions, would imply that the stock could be worth around $293, which is 31% above today's price. If you think that all these catalysts are probable, then that valuation might make sense to you. On the other side of the table, there are analysts who aren't as optimistic, or they're the bearish analysts. Bearish analysts expect earnings per share growth to be way lower, and as low as 5%. That's well below Visa's historical growth rates and would imply a significant slowdown. So they likely think that Visa will face a lot of challenges going forward. There are several catalysts that could support the bearish narrative to different degrees. Firstly, it could be as simple as a major recession, which some economists actually still expect will occur. Visa's business is closely tied to the global economy, as we saw in 2020 when revenue fell 5% and earnings per share fell 8%. If that happens again, these analysts seem to expect that it will take a few years for growth to make up that lost ground again. The second bearish catalyst revolves around the negative outcomes concerning regulation and disruption from alternative payment systems. Regulators are on the warpath against companies with monopoly-like status. The extreme point of view here is that they could go even further than the Credit Card Competition Act in trying to break up the duopoly. Although, it's worth noting they would probably face heaps of legal challenges, so it wouldn't be a quick or easy process for the regulators to enforce. Bearish analysts probably also see the payment networks inevitably being disrupted by new technologies. Finally, the last bearish catalyst likely revolves around some analysts believing that emerging markets won't end up being a growth opportunity for Visa. That might be because some developing countries like China and India already have their own payment networks, and in others, consumers have bypassed bank accounts altogether and moved straight to mobile wallets and apps. So Visa's opportunities could really be quite limited in these markets if this continues to play out. If you agree with these bearish narratives, then you might think that the lower earnings growth rates of around 5% makes sense. A growth rate of 5% per year would imply a valuation of around $145, and even a 10% earnings growth rate would imply a valuation of $177. Either way, in these situations, the stock could have between 20 and 35% downside from today's prices. So if you think these bearish narratives are more likely, then Visa's stock as it stands today probably doesn't look too appealing to you. Now, let's talk about building your own narrative. As we've mentioned in previous videos, it's entirely possible for a variety of the outcomes to occur and not just all the bullish and all the bearish. For example, regulators could have a big impact on the business, but then on the other side, Visa could maintain its market leadership and have heaps of growth in emerging markets. You might also be confident about some catalysts and less confident about others. You can build your own narrative by assigning probabilities to each catalyst and its potential impact on revenue and earnings, which is the most important part. These are just a few of the potential catalysts that we've mentioned, but you may have some of your own that you want to add that you think are more influential on the business's future. So, to build the narrative, it helps to reduce the narratives and catalysts down to a few key questions we can ask ourselves. In Visa's case, you could ask yourself these 3 questions. First of all, do I think the US economy will go into a recession, and if so, for how long? Then, if it does go into a recession, how much will that impact Visa's revenue? And if not, how will Visa's revenue grow? The second question would be, will the US Credit Card Act be passed? And if so, how much will it impact Visa's fees and ultimately revenue? Or will it only affect the issuing banks who currently earn the bulk of the current fees? The third and last question would be, will Visa's business be meaningfully disrupted by new innovations? And if so, how much will this impact revenue growth? By thinking through your answer to these questions, you can start building your own narrative and use it to come up with your own valuation for the stock. If you click on the link in the description, we've written an article that gives these narratives more context. You can also view the Simply Wall Street Company report for Visa, which contains plenty of useful insights that can help you build your own narrative. Lastly, you can use our new Notes feature to build and update your own narrative for Visa on the Simply Wall Street platform so that it's all in one place. Now, that pretty much wraps things up, but we would love to hear from you. Do you think these catalysts we just mentioned are the ones that are most important to Visa, or are there others we've left out? Also, do you lean towards the bullish side or the bearish side for these narratives? Let us know in the comments below. Now, remember, think long term, reach your own conclusion, and be a lifelong learner. Thank you so much for watching, and we'll see you next time.